Hi, I'm Daniel. You're watching Unrivaled Investing. In this video, we're going to talk about HIMS and HERS, or HIMS stock, HIMS. I've actually been covering HIMS for a while now, for a couple of years, back when it was a SPAC, part of Oaktree. I also talked to my subscribers about the warrants for that SPAC, and the warrants went up several 100% within the first year when the stock traded around $20. I at one point did own a stake both in the shares as well as the warrants. I no longer own a position, but I do like to keep tabs of the business because this is one of those businesses that continues to execute really well. And frankly, when I looked at their second quarter results, I was surprised to see the stock performance, where the stock today lost, roughly around 7%. It looks like 5% during the day. It looks like another 2% after hours. Especially it's surprising when you're looking at 43% growth in subscribers. So this is a business that's clearly taking market share. They have a winning sort of algorithm. You see their revenues growing at 52%. This is predominantly online revenue versus their wholesale revenue, but you can also see their monthly online revenue per average subscriber. It's staying around $57 that each subscriber is paying effectively, a little under $60 a month to HIMS. And you can see not only is the revenue delivering, but they're showing significant operational leverage. And this was a key concern of mine for some time, which is, hey, this business clearly is going to spend a lot on marketing. At one point, over 50% of their revenue was going to marketing expenses. Now they would say, hey, that's all about customer acquisition costs. So it's critical to see that they can actually start getting profitability. And they're showing adjusted EBITDA margins, expanding significantly, adjusted EBITDA up 270% year over year. You can see positive net income, operating cash flows up 200% plus, free cash flow up 377%, generating real free cash flows. Yes, it does include significant stock-based compensation, but it is real cash flows. So this is, important for investors to keep in mind. And another aspect that makes this even more confusing to see the stock down is the fact that they raised their guidance for the year significantly, I might add, from effectively I think $1.2 billion in revenue outlook for the year to closer to $1.4 billion. So seeing a significant revenue acceleration, significant margin expansion. Usually when a business talks about accelerating their sales growth, it kind of breaks Wall Street models because they go, wait a second, how do you value? Usually the assumption is you grow at this rate and you slowly level off over time. So when you talk about a business accelerating, Wall Street analysts go, okay, well, what does this business look like in its end state? It's much harder to think about. I broadly like, some of the aspects and the specific strategies and investments that they're considering. And management talks about the underlying themes of the business, which is 85% long-term retention. I think it's important to call this out though. For a software business, you'd expect, very high retention rates. This is not a software business. This is a direct-to-consumer branding business where people they're investing significantly to build their brand and to acquire customers. And their goal is to have significant retention. What's been a red flag from the beginning, and I've called this out before, is that they used to have much more detail on the revenue retention cohorts to show, hey, we would lose, and it is some figure that's like this, lose somewhere around 50% of their customers. It might be a little bit higher their first year, then lose another 40% the next year. But then if you've been with the company for 2+ years, then you're going to have much stickier retention. And that's always been sort of a little bit of a red flag for me, which means that most people, when they actually use a product, given such a high degree of churn, they're not actually, sticking with it. Now, there is a cohort, a minority of the new customers acquired that will stick with it. But I wanted more detail on this. And if anything, management's been sharing less, in my opinion, over time, because at the beginning, when this first went public, there was much greater detail on that retention figure. So that is something for investors to dive into. They do talk about strong unit economics with a payback period of roughly under 1 year. That is something for investors that want to sharpen their pencil to think about, because management's guiding to around $500 million revenue dollars in growth this year, and they're guiding to around $500 million in customer acquisition costs. So, it's for me personally, when you think about that, wait a second, 500 million in revenue. Yeah. Even at 8% margin. So it's, it's just reflecting that it's ultimately, this is a tricky business. And I think investors, this is going to be one of the concerns for investors is, wait a second, are you able to keep that payback period going, where it is compelling, where you keep a payback period of under 1 year, for the future. That said, broadly looking at this business, they're doing a lot of things that investors should like. So it's surprising to see the stock down, as I've mentioned several times. One of the initiatives that they've done that's taking significant share, not only in the broader market, but within the business itself, is their personalized subscriptions. And you can see that's becoming a much larger part of their business. That's the sort of the green here. So this is becoming a personalized subscription business, and that might be personalized through different form factors, like saying, hey, because we're making the investments in the infrastructure, so that way you can get, the custom meds that you want. Maybe that means different chews, mint serum sprays. So that way, if you typically might take a pill, well, now you have other options. So that's why they're saying it's custom, or it might be custom by the dosage or factoring in multiple conditions. Management talks about, how you might have one condition, but you might also have a second. And, here it is, we can combine it all in one pill and it'll address multiple concerns at once. And this is because of the investments that they're making in their various different manufacturing facilities. And they're also making real progress with their weight loss treatments on their platform. This has been hyper growth. I think this is one aspect of why the stock might be facing a little bit of pressure, is because investors were so excited about the announcement that they, were getting GLP-1, that they were compounding it through a partner, and that they would be able to offer it at much lower prices versus the $1,000 that you might see, some players offer. They're now offering it for, around $200, and they have alternatives for $79. So they're making a big push in weight loss. And I think investors were expecting just meteoric growth. And yes, there was an acceleration, but maybe it wasn't as much as some investors were hoping for. But still, this is arguably a big difference where you're able to offer solutions for customers that are much better than the market. This is creating unrivaled solutions when you're saying, hey, we're offering something for $199 versus, the branded competitors that are closer to $1,000 per month. So the question is, okay, so why is HIM stock coming under pressure following this earnings result? So one aspect is their gross margin profile coming in under pressure. And you've now seen 2 quarters where gross margins have headed lower. This is partly because of these weight loss investments, where they're saying, look, this GLP-1 compounded solutions and alternatives that will have a near-term impact on gross margins, but long-term it should revert back to where they are in this, 80% type of gross margins, which is quite high. And there's also the concerns that maybe this uptick in growth is short-term in nature. And you have some investors saying, well, what happens when the GLP-1s, this is the weight loss drugs, are taken off the shortage list? Like this has been a key aspect of their strategy, which is that while they're on shortage, they can use an outsourced compounding facility to sell pretty much the identical drug. It's not labeled the same brand, but it's the exact same product or very similar product. And that's the concern of, well, what if it goes off shortage? Will they still be able to sell it? And they're saying, look, there's a lot of alternatives that they can consider. And they believe they have a really robust range of offerings that we think is very durable. So this business has grown very quickly, 100 million run rate business very quickly. And, they're expecting, even if GLP-1s go off the shortage list, they will still be able to figure out clever ways to market various different weight loss products. So I think that's important for investors to reflect on. Okay, so what are my thoughts on HIMS, thinking about the valuation, of this business? What are some more of the concerns that investors have? First of all, this is not financial advice. I don't own shares in HIMS at the time of this publication. Also, quick plug, recently a premium member of the Unrivaled Investing community shared, this is a direct quote, Currently, the profit I've made thanks to called out ideas from Daniel can pay for 30 years of subscription, but the most valuable part has been the learning experience. I've been a very satisfied member since June 2022. Since then, I've never doubted to renew. That's a direct quote. So if you're looking for compelling ideas, come check out unrivaledinvesting.com. If I want to think about, what are the concerns that investors have? So I go to AI Ticker Chat. Now chat is completely free for you to, chat with any of these US companies that we cover at AI Ticker Chat. So I typed in, outside of lower gross margins, what were the top questions, concerns analysts had on the recent call? And it called out the concerns that, look, they are investing in new facilities, and how will these new facilities impact their margins and the unit economics of this business longer term? Because that is a strategic difference, using outsourcing facilities versus making this internal capabilities investment, this transition. There is a question of how long, will they be able to leverage their marketing expense, where they continue to get economies of scale, get efficiency, with their cost structure, where they're able to say, hey, we're going to spend less for each dollar. In terms of each dollar of revenue, instead of maybe 50 cents spent on marketing, we spend 40 cents or 30 cents in the future. How sure are they that they'll be able to achieve those favorable unit economics, given that so much is being spent on marketing? Also, just a quick note, with AI Ticker Chat's chat feature, which is, as I mentioned already, completely free, we are now offering a share and win contest. This is only for the month of August currently, which is that if you use the chat feature and then share the conversation you have a chance to win a Pro Intelligence subscription, which has a value of around $600 per year. So check that out if you're interested in terms of sharing the conversations or trying it out yourself. I think you really have nothing to lose to try out, in my mind, compelling AI and ask the stocks that you're interested. That's at AI Ticker Chat. So going to the question of the long-term margins of this business, you can see marketing 51% of revenue, this quarter 46%. And this gets to the uncertainty of, hey, can they keep scaling this? And this gets to the heart of why this stock will be so volatile, is whenever you have a stock where you're saying, hey, the valuation based on trailing numbers doesn't really make sense. You have to say, where do I think margins could be in the future? And if that figure is going to be way different than where it is now, that'll create significant volatility in the stock. So I would say investors in HIMS should be mindful that it can be extremely volatile. So looking at this chart, thinking about this, putting on my own personal CFO hat, I think the goal is to leverage marketing from 51, 46, let's get it down to 30% or so, 35%. And, if you're talking, let's say gross margins around 80%, they 75, 80%, you're able to get marketing in that, say, 35, 30% range. Okay, so that still leaves you 50% that you could be investing in that business. So 80% less 30% for marketing gets you to 50. And then you still have, general and admin, tech and development, and operations and support, which you see here. And so, the question is, what can you get this to over time in terms of those margins? What can you get these costs to? And maybe, various different companies have different rates, but maybe that's closer to 20% over time. Right now, you can see it's closer to 30%. So if that gets to 20% over the time, then you're talking about maybe 30% margins. So let's be conservative and say 15 to 25% margins long term. This is operating margins. Management talks about 20% EBITDA margins by 2030. So, this is sort of squaring this analysis, sort of saying, what could their profit, their GAAP profit look like in the future? And so I think it is possible to pencil out a framework of 15 to 25, but there are a lot of assumptions that go with this. And that's why the stock will be so volatile. So thinking about the range of hypothetical range of outcomes for the stock for the next few years, I go to, once again, AI Ticker Chat, use a predict feature. And this is leveraging AI to read all the transcripts, read the financials. And based on what it knows about a lot of different companies, AI saying, hey, this is the range of growth prospects. This is the range of margins. This is the range of valuation multiples in the years ahead. And it's suggesting that there's nearly 500% upside in the years ahead, maybe 40% downside. So that is, I'd argue, skewed to the high side. My personal take, if I'm going to, tweak these numbers a bit, I'm going to tweak the growth assumptions down significantly. I think 40% plus growth on the bull side, that's just incredibly difficult to maintain. So let's assume 15 to 25% is what I'm assuming here. And then let's go, 10 to 20% for the margins. This is in line with the conversation I was just having about maybe they get to 15 to 25%. So this is the next 5 years. Where could they be? And let's assume, a valuation range. I think 40 times is probably way too high for oftentimes discretionary purchase. So from a consumer perspective. And so you're talking about, if you're talking about hair treatment, something like that. So 17 to maybe 30 times, a little under 30 times. So that does still get a stock where it's skewed to the high side. It's not as much as AI Predict was initially thinking, but there still is meaningful downside if they don't execute. I look at HIMS broadly, thinking I don't think it's going to be right for my own personal investment journey. I like I've called out Fairfax before. Fairfax is one of my top positions. I've done videos on it. I like a good or service where I believe it's critical. Insurance is critical for the end customers. And even if there's a recession, Fairfax can do really well. As an argument, and I'm going to talk about in this week's letter, Fairfax will benefit if there's a recession because they can upgrade their investment portfolio from treasuries to corporates. So, that is the type of situation that I'm personally looking for. That said, I can understand why other investors do like HIMS because if they continue to execute, if they continue to deliver, it would not surprise me at all if there is significant upside from here. And I don't think I'm alone in that assessment because here it is. And this is something that I think is really notable. They have a new member of the board of directors Mr. Schultz, who previously worked over 25 years in the pharmaceutical industry, including at Novo Nordisk. Novo Nordisk is one of the companies creating the GLP-1 drugs. And so he was the president and COO. He helped establish their, leading position in diabetes care. And that's what the GLP-1 drugs were initially intended for. And here's a direct quote that I think is relevant. In my long career in the pharmaceutical industry, this is the first company I've seen that is leveraging today's modern tools to truly break down barriers and change the status quo of how people access the health solutions they need to live their fullest lives. I'm thrilled to be a part of this journey. That type of mentality, suggesting that they are truly changing the industry, does, in my mind, increase the odds of that favorable outcome where you're saying, hey, this could be several 100% higher in the years ahead. It's just going to require a lot of execution, managing their costs in an intelligent way where they can continue to bring down their marketing spend from 50% to 46% to maybe 30% someday, and continue to create new innovative products that are sticky. I would love a little bit more detail on their customer retention because that is always sort of a concern in the back of my mind, which is, are you sort of boiling the ocean, going through as many customers as possible, but there's just really, really high churn? And is there some sort of, cliff aspect to that where, you just go through this whole population and then boom, it just sort of levels off? I don't think that's going to happen. I think that's a low probability. Another real risk is some sort of recessionary impact on the business, but management calls out in the most recent call, they're really not seeing any impact. And if anything, they're seeing an acceleration in the business because of some of the products that they're launching and innovating with. So overall, I applaud how they've executed, how they've delivered so far. This is one of the few companies that have said, hey, we're going to do this, and they do way better. So really solid execution so far. If they keep it up, would not be surprised to see this stock much, much higher. That's my own personal take. I don't have, a position in it. I'm just very curious to watch, continue to watch how it performs. If you enjoyed this video, please make a point of hitting that thumbs up, hit that subscribe button. Thanks so much for watching Unrivaled Investing.